To remain updated with the latest business news, click on the bell icon.
Hello and welcome. You're watching Business Today. I'm Sakshi Batra, and the National Statistical Office has now reported that India's gross domestic production numbers for the months of October to December 2021 have come in at 5.4%. And this is much lower than the street estimates and wider estimates of most of the economists, which were ranging between 5.9% to even 6.6%. I have with me a very special guest joining right in to help us understand what these numbers really mean for the state of the economy right now. I have with me Ms. Madhavi Arora, lead economist at Emkay Global Financial Services, to help us understand how to interpret this data right now. Thank you so much, ma'am, for taking out time for this discussion. First up, help me with your take on the headline number. Is it as per your estimate, below your estimate? How are you reading it?
Clearly, it's much lower than ours in street estimates. We were looking at around 6.2% for the quarter. And it obviously puts immense pressure on our annual growth number, which also apparently, as per the CSO, is now revised down from their early estimate of 9.2% to now an 8.9%. So clearly now we are looking at a sub 9% growth overall for the year. A part of that can be attributed to the fact that we saw revisions in the past 2 years data, which were not reflected when the government had come out with the first estimate of the current financial year. At 9.2%, which was used essentially for the budget estimation.
Yeah.
Nonetheless, I think the third quarter number clearly, seemed to have been much lower, especially the manufacturing print. We were looking at a much slower growth in both mining and manufacturing, and probably still a positive number on construction. There were clearly, some impact of the base effect, and plus the fact that there was supply chain disruption, which especially in the auto sector, which was impacting the manufacturing data. Even the sequential easing in corporate profitability also showed the same kind of weakness, but clearly it has surprises on the downside. Even in the near term, we are seeing most demand indicators looking at a bit of a peaking out, and a bit of slowdown that is reflected in the rural sector. So I think the fourth quarter, which obviously was also hit by mild Omicron, would see further bump down, and hopefully, going ahead, it would be relatively stable sale. But again, we have a lot of uncertainty happening from the global point of view, so we'll have to see how things really pan out. But clearly, at this point in time, the numbers seem to be much lower than what we were penciling in.
Absolutely. And, GDP has now slowed down to the previous 2 quarters as well. Of course, just like how you pointed out, the normalization of the base effect is perhaps happening right here. There was a 20.1% uptick in Q1, then there was an 8.4% growth in Q2, and this quarter we are at 5.4%, and the FY'22 estimate has now been lowered to 8.9% from the initial estimate of 9.2% as well, just like how you pointed out. I also wanted to understand on the GVA front also, it's coming at 4.7% as well. So that's further lower from the GDP numbers. How does one really interpret both these numbers for our general news audience also? If you could help them understand what this really means, how are the two different, and how does it matter to understand which one is more appropriate to understand the state of the economy?
I think for gauging the state of the economy, I think GVA is a much better indicator, because it actually, the calculations which are done in estimating GVA are much more stable, with what we see in GDP, which is more volatile. The difference between the two essentially is the net taxes, which is basically adjusted for subsidies. On an average, the GDP tends to be higher than GVA, simply because on net basis, the subsidies are going down and taxes have generally done better, which is what we saw in this quarter as well, and for the year as well, as a whole. I think for broad understanding, it's better one sees the GVA numbers, which are relatively more stable. And again, as per GVA, even though this quarter and probably the following quarter, we'll see services leading the pack, partly because of the base effect and partly because of huge government spending, which has sort of increased in the third and the fourth quarter of this financial year. I think a large part of push that is coming in the growth picture, both from GDP and GVA side, is on the back of the government spending, which has been a big lever in the second half of this financial year. I think given the state of the economy, I think even the capex fund, the government is going to be leading the capex story for the next year as well, while the consumption story looks to be clearly fading on the private sector side, and government again will have to sort of take on the baton on that front as well.
Okay, understood that as well. Nominal GDP also is likely to grow at 19.4% as per the NSO estimates right now. Could you help us understand what this would mean?
So this is basically a deflator driven uptick in nominal GDP, because the FY'22 saw a huge increase in wholesale price inflation, which is averaging close to 11-12% for the year, and has a much higher weightage in the deflator for the economy, which is basically the overall economic inflation that you see, which is basically a weighted mean of your GDP of wholesale inflation as well as retail inflation. So I think basically the sharp uptick that you've seen in nominal GDP is essentially a reflection of the fact that we saw a very high inflationary regime last in this fiscal year, and which is why the gap between the GDP and nominal and real GDP is quite huge, which is basically your inflation, the overall economic inflation.
Right, absolutely. The finance minister has time and again said in the monthly economic review and previous comments also that Indian economy is poised to grow at its quickest pace among the League of Large Nations also. But with 8.9% now as an estimate, where will we stand?
So I think we may still end up being one of the fastest growing economies in the world. I mean, 8.9 is no joke, but again, a large part of it is led by base effect. And the fact that, still some segment of services is still not reached the pre-pandemic level. Private consumption, to be specific, has not seen the pre-pandemic level. I've not seen the numbers as yet, but I think by end of the year, it should be in line with what we saw for 2019-20. But again, one has to understand that on a CAGR basis, we are still not growing. We're just growing sub 2%. And we are still going much lower than the output. The potential output suggests. So clearly there's still a output gap in the economy, which is pushing us down in terms of the demand side. So there's still a decent amount of catch up that needs to be done, both from the private sector as well as from the policy sector.
Absolutely. Also wanted to ask you, how are you penciling in the impact of the COVID Omicron wave, which was not fully penciled in perhaps in this Q3 numbers and may also reflect some part in Q4 numbers as well, and the risks that are mounting from the higher prices of commodities, the crude oil prices surging over $100, $105, inflation rising, and Russia's invasion of Ukraine now that has emerged as the latest risk. So how do you pencil in all of these risks going forward?
So the Omicron infection, would not impact the recovery in a very material fashion. You would see a minor steep speed bump in the fourth quarter of FY'22, as it only led to a very small reduction in mobility levels overall. And there was a very quick recovery from the infections, as well as the fact that now we are sitting with a very comfortable, vaccination level. So I think a minor bump down in the fourth quarter FY'22 would be sort of covered in the following quarter. I think that Omicron is not that big a worry at this point, maybe a 10-20 bips downside that one would have penciled in for the fourth quarter. I think the bigger risk which is emerging at this point in time is the global uncertainty owing to the higher energy and commodity prices because of the geopolitical tension that is panning out. And that could actually reset the whole global energy scenario in the world. At this point, we are still assuming that it could be a temporary shock for a quarter or so. Nonetheless, it could lead to a new level of Brent. At this point, I think most street economists as well as the Reserve Bank of India are working with a sub 80 average Brent price for their forecast. I think all of us would see some bit of a revision happening at least in the first quarter, and that essentially would mean that the first quarter growth could see a decent amount of downtick. It would not just be India, but I think energy inflation across the world would lead to some revision down in the growth levels. But I think you would see a catch up, assuming that the geopolitical tension sort of subsides. On a more sensitivity point of view, I think if you really assume that Brent from the current level, from the current average that we had taken, which is $78 per barrel on an average for the year, if I'm assuming Brent to be going to 88 to 90 on an average, I think the bump down to growth could be to the tune of around 35 to 40 bips, which is a decently higher impact. And the global growth could also be actually come down to the same kind of level. So I think there is a decent amount of uncertainty risk which is coming from the trade route. Financial route again is something which is not essentially being captured in this scenario. So any kind of financial disruption could also come via the FX routes or the rates route, which could again be more disruptive. So at this point, I'm just considering the trade route, which is essentially coming via the oil impact.
Okay, but would that mean that you would also be revising your estimate for, say, Q4 and the entire financial year as well?
I just need to see the numbers, but I think we need to start penciling in the current, geopolitical tension as the reality for the quarter at least.
And how much, if you could give us a broad, outlook as to what kind of an impact would it have?
So as I said, we were working with a sub 80 on Brent on an average for the year. We need to still discuss as to how much we would be increasing the average Brent price. But, assuming that the average bumps up by around 10 bips, the impact on GDP would be lower by around 35 bips or 40 bips roughly at this point in time.
And what were you penciling in earlier?
My numbers were quite high. So looking at 9.6 for FY'22 and 7.8 for FY'23. So I'll have to revise on the numbers according to the current release that has just come.
Okay, understood that. How would the RBI now read into this, keeping in mind that the RBI has been fairly dovish in comparison to the global central banks with respect to the rising inflation. Now with growth slipping even further, how does it really, come into the monetary policy purview?
I think at this point in time, I'm not changing my RBI's stance. I think there still would be focusing more on the domestic dynamics. As I said, I'm playing it as a 1 quarter story, which again could obviously lead to a lot of change in equilibriums. But my sense is that, given the fact that it could lead to a bump down in global growth as well as domestic growth, I think central bank would still be more wary of the growth impact than the inflation impact in the immediate run, because again, it's a supply-led inflation, which RBI, at least from their point of view, seems to be something they cannot control. So they are more a demand-centric reaction functions, which means that unless, of course, it start impacting demand on the other side, which basically means that there's a uptick in demand, which is genuine, RBI may not immediately change the stance. So I think there's a decent amount of confidence that I have that we would not see RBI moving needle until at least the second half of next financial year.
Okay. And on ground, what kind of an impact would this lower pace of expansion have on, say, investments and job creation as well?
So I think immediately owing to the Russia crisis, not much. It would probably have more impact on the margins on the firms, which obviously will have a second-order impact on their revenues and the way they, do their investments. I think the broader picture, I think, with regard to the domestic dynamics of the economy has been the missing elements of both investment and consumption in the private sector, which I think would probably continue irrespective whether the Russian crisis gets resolved or not. So I think the missing economic agents, be it household consumption or private investment, will probably continue in the next 1 year or so at least.
Understood that. Well, on that note, thank you so much, Ms. Arora, for speaking with us and sharing your insights on the latest GDP growth numbers. Q3 GDP at 5.4%, much below the expectations. This also indicates that further going forward in Q4, there could be some further revision downwards of the estimates that we've been penciling in so far. And for the entire year, the estimates now say 8.9%. So we are, seeing an expected growth of 8.9% for FY'22. How does this all augur well for investors going forward? We will have a lot of conversations with our market experts as well on that. So do stay tuned on to that conversation as well on Business Today. Thanks a lot for tuning in for now.
If you like the video, do like, comment, share and subscribe.